What does transitory mean to you? Every commodity we talk about is higher now than it was a few months ago. How long do you and your team see inflation rising?
Well, commodities, again, are going to have a supply response in the coming year. Tell me a year in which we don't see the oil price rise sharply and production doesn't follow. So I think from the perspective of headline inflation, I'm less worried about the coming 12 months. If you just take a look at futures prices, they're about 15% lower 12-month delivery than they are now. Even if that doesn't happen, we're going to lose a big spur to headline inflation. Now, clearly, central banks taking a different approach to inflation compared to the last 40 years, running labor markets tight, having core services prices rise more than 3% is an underlying inflation trend that's higher. But we still think that we've seen a lot of distortions in the economy. Just take a look back at what fiscal stimulus was at the beginning of 2021. It annualized 13% of U.S. GDP.
Yeah.
Are those payments happening again? They're not. So that spur for inflation seems to be temporary. I think next year you'll have 3% headline inflation out of the U.S.
That's unbelievable, Steve. I mean, so what does that mean? What happened? If you're right, what happens? What happens to bond yields? What happens to equities? What happens to gold and cryptos?
Well, if we're wrong, it'd be a bigger problem. If you take a look at what's happened to the bond market has been pricing in 10-year inflation just above 2.5%. Now, that's a lot higher than, let's say, the 1.8 that we had in the 10 years after the global financial crisis. But markets are generally taking the view that this is a distorted economy, that supply and demand have changed too fast for producers to keep pace with. But that's not a long-term demand problem, right? So if instead, for some reason, we just have much more demand than the economy can supply, well, then we're going to have a more lasting inflation than, we're talking about the next 6 months still being relatively high. When I mentioned next year, I thought about year average CPI, which get, again, a lack of follow through from some of these temporary factors. So it'd be a bigger problem for markets, not necessarily, well, I would tell you this, the composition of the equity market would be quite different. The bond market, which has a global yield of 1%, makes us look rich. So I'm not sure the bond market is really going to compensate you for a great deal of inflation.
No, and they're not. In fact, bond yields are down from where they were a few months ago when we weren't even talking about inflation. That's what's remarkable. How long are we going to be low? Are we going to be low forever, or at least for years, Stephen, on government bonds?
We look at this environment is quite similar to the aftermath of World War II. 100% GDP, debt to GDP ratio for government bonds at the peak, the end of World War II. 30 years later, it was 25% of GDP. Inflation, low rates, the purposely keeping rates low for a long period of time helped with debt burdens. I don't think we have to accept double-digit inflation in a bunch of recessions to end it, but it was a long-term process. And certainly what's happening across the world, where yields have stayed even lower than the U.S. You can see that we've tapered, right? And take a look at what the dollar has done. It's gone up. There's some confidence that if we're not handling inflation very well, we're handling it a little bit better, perhaps, than the outlook for other developed market economies.